Rich, today we're sitting down with the Chief Growth Officer of World Insurance, and we talk about a lot of areas that really entrepreneurs need to investigate a little bit further if they want to save a little dough on their health insurance costs.
I found it interesting just how limited of options there were for smaller businesses, and equally interesting how many options there can be as a business grows.
Yeah, absolutely. We're dealing with a little bit of a crisis here. We talk about crisis sometimes a lot. There's an inflation crisis, there's a pandemic going on, there's different things going on, but one of them is the medical inflation crisis. And every year you get your bill, it's 30% more. You have to investigate the options that are out there for the betterment of your business and the betterment of your employees. Here's Mike Barton. Hey entrepreneurs, are you looking to take your business to the next level? I'm sure you are. Listen up. The Entrepreneurs United Empowerment Experience is coming to Austin, Texas on October 2nd to the 4th, and you do not want to miss it. At this exclusive event, limited to just 50 entrepreneurs, you'll have the opportunity to connect with other like-minded business owners and CEOs, learn from industry experts, and enjoy unique experiences that you will not find anywhere else. The Entrepreneurs United Experience will leave you feeling inspired, energized, and ready to take on whatever opportunities and challenges come your way. So mark your calendars now for October 2nd to the 4th, and join us at the Omni Barton Creek Resort in Austin, Texas. You will not regret it. Visit entrepreneursunited.us to learn more and secure your spot today. Mike, welcome to the Entrepreneurs United podcast.
Thank you. Appreciate that, John.
We were connected through a mutual friend, but also our company does some work with your company. So I'm excited to have you on our podcast and have entrepreneurs listen to a little bit of what your company does to help entrepreneurs with their business, grow their business, protect their employees, all the things of that nature. Before we go any further, I may have spilled the beans a little bit. Can you tell our audience and us a little bit more about you, your role, your company, and what you guys do for entrepreneurs?
Absolutely. My partner and I work with a company called World Insurance. We work with employers across the United States on all forms of risk mitigation and insurance to make sure that we can cover the things that matter the most to them in the most efficient manner possible.
Okay. And you're the Chief Growth Officer.
I am. That's a big fancy title, but all that really means is I try to get out and meet with as many of our clients as I can and then talk to prospective clients as well.
Okay. And you guys are one of obviously the largest, fastest growing brokers in the United States right now, I believe, as well. So there's a lot to be said there about how much travel you're doing, as we talked about before this conversation. So you guys are growing at a rapid pace. We like to typically ask our guests a really sharp question right off the bat. And I think this one would be, I'm an entrepreneur. I've tuned into this. We're about 30 seconds in. Why should I keep listening to Mike?
Wow, that's a good question. That is right off the bat. I think if your interest is in insurance and mitigating those costs, the next 20 or 30 minutes could be meaningful for you. I specifically focus on healthcare. So I was recently retired. I came out of retirement to come back and do this, and I came back for a very specific purpose. The cost of healthcare is just unabated during my lifetime. It's doubled CPI for the last 5 decades. It's a problem. The cost of health insurance for a family is at this point more than the mortgage on a 3-bedroom house, and I wanted to take a swing at the pitch. So that's what I'm here doing, and that's what our colleagues at World Insurance are aligned around doing.
Okay, awesome. So let's address that problem right off the bat, right? If you're an entrepreneur that has any business, no matter if you have 10 employees or 100 or 500, every year you get that renewal bill and you're like, how is this going up 30% again? This doesn't make any sense to me. And yet you don't have any choices because you're putting it out to bid or you got these things coming in. What on earth are you doing about that problem to help entrepreneurs? And what should entrepreneurs be doing to help themselves?
Yeah, so it really depends on the size of the employer. So your options are fairly limited if you're in the reform market. Reform market, our employer sizes 2 employees up to 49. You get out of the reform market once you get to 50. Within the reform market, you have obviously public and private exchanges with a handful of carriers who participate in that. But really, the carrier landscape is essentially a government sanctioned oligopoly. You've got 4 players. You've got Aetna, Cigna, United, and Blue Cross. Used to have Humana. They've gone pause up and decided they do not want to do commercial insurance anymore and focus only on Medicare. So when there's 4 players, regardless of what market segment you're in, you guys know this because you do the Entrepreneurs podcast. If you have a small marketplace with a small number of people who produce that product, the level of competition goes down, not up. The way the rules are structured, it's the barriers to entrance for new carriers is very difficult.
Got it. So it's hard to get in and become an insurance company. And when you say oligarchy, all I can think of is the Russian oligarchs and all their assets being frozen when the Ukraine war started.
So
You
did
got
I say oligarchy? I was reading too much in the paper today. I meant oligopoly. How about that? That's
maybe you
even
did it.
better.
Maybe that's just what I heard. But all I could think of was these four people that they're the only ones that can run these insurance companies, right? And so they get all the biggest buildings in every city because they're the insurance group. So it sounded like it made sense to me. But either way, there's four of those groups. So what? So do we throw our hands up? Like it's hard to become an insurance. There's not going to be more. There's not going to be competition. Prices don't come down. What are we left with?
So I would say again, depending on market segment, if you're a smaller employer, some of the easy things that you can do, and they sound simple, they might be a tad complicated to do, but the best way to reduce your overall health insurance spend is to reduce the demand on insurance, which is healthcare. So a couple things. There are tools that exist out in the marketplace where you can determine who a high performing provider is. And when you can do that, go see a high performing provider. They will have, typically speaking, greater adherence to evidence based medicine. You'll have a better clinical outcome. And by that, if you have some form of a surgery, inpatient or outpatient, will be lower complication rates, lower readmittance rates, that sort of thing. So find the best doctor you can. Usually, the best medicine is always in the long run the cheapest. So that's point number one. Point number two for your employees, it's going to sound incredibly obvious, you guys, but the most important thing is to go out and get the very simple screening. So for kids, it's immunizations, get your kids immunized. For men, it's prostate screening and colorectal screening. For women, it's mammography. So those are some easy things that you can do as an employer to encourage people to go get those screenings. And it could be as simple as, hey, I'm going to give you time off work to go do it during the middle of the day. It could be a gift card. Hey, I see that you got that. Terrific. Here's $25 Starbucks gift card. Go grab a couple of cups of coffee. So the reason why you want to do that is you capture those small claims before they become big claims. Those big claims take people out of productivity. In some instances, they end life. And it's the right thing to do in terms of reducing, again, the demand on healthcare. So in the smaller market, those would be the very simple things that I could do that employers have at their disposal today.
Okay, so let's pause there then. We're talking about reducing the demand on health insurance by basically stay healthy, right? It's
We're
stay
doing
healthy,
your
get
best.
pre-screened, get a good doctor, take care of yourself. That's at that particular size of company. But my understanding, and maybe it's faulty, is that when you're a company that 50 plus employees, but you're around that zone, you're looped in with every other company. So you could have the healthiest, fittest company of everybody's in perfect health condition, but you're looped in with the other 10,000 companies who may not be taking care of themselves. So I understand you want to do it for the health of your employees. That's a very good thing that entrepreneurs should be doing, keep people healthy and working and lively and energy and everything. But do you really get the benefit of it from an insurance perspective?
So when you're very small, that benefit is muted because you'll be rated on a manual rating or a community rating basis, which is what you're describing. However, it's manual rating or community rating plus. And the plus is in the presence of large claims, you could get the manual rating plus the cost of your large claim.
Okay.
So it can hurt you.
Okay.
So does it help you so much? It's debatable from an insurance perspective because you'll probably get the de facto manual rate, but it could hurt you if you don't mitigate those claims. The other thing that, setting aside just simple insurance matters, there's a qualitative benefit to helping your own employees live healthier lives.
Yeah.
And again, without getting into the whole wellness generation one, eat better,
Yep.
move more, sleep better, take your meds. Of course, everybody should do that, but as a generation, we've utterly failed at that. So if you're going to fail at all of those things, go see a good doctor and get your screenings.
Okay. And at what size, because you made a comment there that I dig deeper into, at what size are there more options? And I'll give you another example. I've been hearing about some larger companies who literally are putting their own doctors' offices in their buildings with private practice doctors. It doesn't feel like a waiting room of a hospital, and they're being more proactive. At what size do you start having more options as an entrepreneur to control your own destiny on health?
Yeah, I would say for me, there's three categories or segments of business. I would say the reform market and then the 50 employees to 500 or 1,000 market and then 1,000 and above. So we talked about the reform market. Let's go to what I'll call the classic mid-market. Those employers more increasingly are turning to some form of a participating contract where they can participate in their good experience, or go self-funding with stop loss. When you do those two things, you tend to be able to carve out some administrative waste. So things like premium tax or state mandates, that sort of thing can come right out. And you also cap carrier profit margins and expenses when you're able to unbundle from a fully insured program. You would typically couple that with some form of stop loss, either individual coverage for large claims or aggregate coverage for all of your claims in total. Most employers in that segment buy both. And then that way you can redesign your own plan on an unbundled basis, keeping in place a lot of the same protective or insurance mechanisms that you like with full insurance, but stripping out a lot of the things that you don't like in a guaranteed cost program, which is essentially guaranteed profits for the carriers.
Okay, so is this another word? Is this basically the captive space where that's another word for that?
So captives would be the stop loss
Okay.
or a pool to take out large claims out of your own experience. So if you're self-funded, you'll have, 80% of your folks will probably not even satisfy their out-of-pocket maximum.
Yep.
So they're not hurting your plan. But you could have roughly, I don't know, 6 people per 1,000 employees who are going to get sick. And when those people get sick, they could have a large dollar claim. And let's just say you set your pooling level, your stop loss level, you call it a captive level, pooling level at $100,000. The claims over that would go to the captive in your instance. But there are conventional markets for stop loss in addition to captives. They do the exact same thing, but they don't force the buyer to become an insurance company. So the idea is it's a leveling effect. You take the variability associated with large claims above a certain threshold and you throw it over the wall. So those things do exist for those employers. I think the that's Gen 1, and that's been in place for a very long time. I would say Gen 2 is doing those same things to make the purchase of insurance more efficient, but then modernizing the programs with point solutions around disease management, all getting back to the demand management issue that I mentioned as we kicked off. So insurance carriers have always had disease management programs. I would say in the world of Gen 2 and hyper modernization of plans, you've seen a cottage industry point solutions come to life that focus on one specific disease state. You have companies that focus just on diabetes, just on hypertension, just on musculoskeletal, just on mental nervous, just on teledoc, just on maternity or fertility. And that's the only thing that they do, and they are hyper good at it. So now for forward thinking buyers, you have the opportunity to not only self fund and do stop loss or captives, but you can also essentially optimize each piece of the healthcare delivery chain by disease state,
Hmm.
and replace good for great all along that chain. And in doing so, you can essentially accelerate the savings associated with going with self funding. But at the same time, you have this added bounce effect, again, all related to demand management, the demand on healthcare. If you have the best in class partners all lined up for all the various disease states, and they're muting or mitigating the cost of those disease states, you can also impact medical inflation over time. So you win twice. You bring down your overall costs, but you take this crazy thing called medical inflation, which has been trending. Oh goodness, last year it was 10.5%. It's probably close to that right now. Even when CPI was 4, it's higher than that right now, obviously, but
Yep.
I presume that will normalize at some point. You just can't have medical inflation trending at 2.5 times CPI. That makes a a bigger problem over time. So by modernizing your program, by self-funding, you can reduce the cost and reduce trend. And we believe you can reduce trend to a number more consistent with CPI through the types of programs that I've mentioned.
Mike, if I take a step back and go, all entrepreneurs start as a smaller business. Many entrepreneurs start as a solo business.
Yeah.
I'd like to speak about the entrepreneur that has 20 or less employees that I
Yeah.
think you're calling the reform market. And you started by saying there's public and private options. Can you take me down the decision making tree of the options for someone that has 20 or less employees?
So for 20 and less employees, it really does become an exchange-based program. You can go to the marketplace and ask your advisor to go get quotes, which of course they do. We do that as well. You'll come back with the same cast of characters. It'll be four-ish vendors that will quote on your business. The problem with that is they all use the same underwriting methodology, and they all file that same underwriting methodology with the Department of Insurance in that state. And then in some instances, they've actually participated or chose to participate in public exchanges. In some place, they're in private exchanges. Whatever the case may be, unless it's a public exchange, the rules for how you underwrite are filed, which means you cannot deviate from those rules. Those filings are also public. Because those filings are also public and there's only four carriers, they tend to read each other's filings. So it just leads to a more, I guess the healthiest way I can say it is consistent underwriting approach in the marketplace. So it tends to yield the same results every single time you go to market. And really, the only differentiation is just differing economic cycles among the four carriers. So maybe Aetna is having a bad 2023, and the best way to get a little bounce in early 2024 is to open up the underwriting in Q4 in the reform market, and they'll get a little bit more aggressive and take risks they wouldn't normally take. And they'll
So, Rich,
assume
I think another way to put it is you're screwed. If you're under 20 people, you don't really have a lot of options, it sounds like.
there aren't a tremendous amount of options. It does make it difficult to purchase insurance efficiently in the reform market, which again is a big problem.
Just to back up, there are four vendors, and I think you name them as Aetna, Insignia, United, and Blue Cross. Are those the four?
Yes, they are.
Okay.
And
And
I use Blue Cross as one company. It is, of course, not one company. They are several, and in some instances, many companies, depending on the geography.
okay. And all four vendors use the same underwriting principles, in part because they have to file with the Department of Insurance, and it's public information what those filings are. And that results in you're going to get very similar quotes. They're not going to be very diverse between the four big vendors. Am I capturing kind of the limit of what's available for 20 or less in a company?
Yes.
What's the alternative option? Not offer insurance, or is there any alternative option to
Yeah,
playing with the
there
four big
there there
players?
are alternatives. What some employers are doing is just punting on insurance altogether and essentially providing an economic stipend for employees. And just say, hey, instead of providing insurance, I'll bump your salary $5,000 and you can go out in a public exchange and buy insurance yourself. There's also programs called ICRAs, which is basically an employer sponsored program where you do the same thing, but it goes back on the exchange. The employer contributes X amount of dollars, but then the ICRA, the platform itself, goes on the exchange and allows people to make individualized decisions, again, using some employer subsidy. So there are ways to skin that cat, but there's not a terrific way to reduce the problem itself.
I've heard of one that I loved. My wife Amy was working at a company once, and what they did was if you were on your spouse's plan or somebody else's plan, they covered any of your out of pocket that you had personally.
Yeah.
And so they saved a ton of money because you're like, wait a minute, I can get 100% coverage. So I can go on my spouse's plan. And then if I have any out of pocket for co-pays or whatever, this company will pay for it. It was a phenomenal idea.
Yeah, and employers have been trying to get members or dependents off their plans for years. Dependent eligibility audits were a big thing. People who enrolled in plans that shouldn't have never been on the plan. And then there became incentives to get spouses off the plans. Spouses are just as expensive as employees. So if you're an employer, you typically don't mind insuring kids because you get revenue in the form of contributions for them against very little expense. Spouses cost money. So everybody usually offers some form of a spousal subsidy for your spouse to get coverage on their own plan through their own employer or
Mike,
paying their deductible or out of pocket expenses. So,
Mike, sorry to ask a question out of ignorance here, but what is AFLAC and what place do they play? I have very limited understanding of them. They have a duck that quacks. They're very memorable. I think they pay for some out of pocket stuff. I don't know. What place do they play and are they worth even looking at?
Yeah, so Affleck has phenomenal commercials, so good for them. The duck has made its way into all of our cerebral cortexes. But essentially, these are voluntary, individualized benefits that somebody can go buy that just frankly pay cash when you are sick or have an accident. And the cash is designed to offset your out-of-pocket expenses when you go see the doctor. So that's really it in a nutshell. I would say that the value of those products, whether it's Aflac or others, it's again, there's a whole series of companies that play in that sector. It used to be the loss ratio on those products was very low. In other words, if you collected $100 in premium, they would probably pay $40 in claims, and that's a bad. If you're a consumer and you paid $100 and you got 40 back, you wouldn't want to make that trade very often. Because there are more entrants in that space and more people are buying individual voluntary benefits like that, the competitiveness for the process has driven the price down, and the loss ratios are more in the 70% range. But still, you're still trading $100 to get 70 back, right? You have to really think about, is that a good bet for me and my family? Am I at a high risk for an accident or illness? Or do I have a crazy high deductible on my health plan that I just need to do some personal reinsurance against?
And the assumption is, in order for that to pay off, you have to be avid at working the system and get the $30 refund for the bike helmet and get the submit the claim because you went to go to the doctor twice over the course. There's work involved in actually getting your money back on that. But if you do avidly work the plan almost as like a mini part-time job, it can be worth it. But if you're not committed like that, I'm hearing it's probably not worth it for you.
It could be a tough trade in those instances. I will say that the carriers have done a good job of offering other wellness related benefits that is a bit of a give back. They'll pay you to go do certain things to get healthy, and then that payment obviously is a way to subsidize other things.
Got it. Mike, what would you say if there was a I don't do this. I've seen some entrepreneurs go down this track as it relates to their insurance or employees. What would be that don't do? And what would be the on the other side? I know it depends on the size of the business, but what should entrepreneurs be doing? Because a lot of entrepreneurs, I feel, because I've been there, it's a little bit of an afterthought. It's kind of, yeah, I get the invoice every year. It's 30% increase. So what? I don't have a choice. So it's kind of just keeps rolling. But what would be a don't do and a do for entrepreneurs?
So the don't do would be, don't be afraid of looking at alternative financing for health insurance or self funding with stop loss or a captive. Too often, I speak to business owners and operators who have some bias against it because they heard a story or a rumor, or 20 years ago they were with a company that was self funded and something went wrong. The price per employee is too high for them to not at least consider performing an economic feasibility study on it and at least look at the math before you reject it out of a hand. So the don't would be, don't give up on it just because. I encourage everybody I talk to of a certain size, you should at least look at it. Whether you decide it makes sense for you or your organization or not is a completely different story. But if you're not doing a self-funded feasibility study, you're making a business mistake.
Yeah. One of the things that we did with our business when we got to a certain level was we actually formed a captive insurance company. And we still have our commercial insurance coverages, but there's a lot of stuff that the commercial insurance doesn't cover. So we got a captive insurance company that we formed that we own that is a phenomenal vehicle because it provides all these extraordinary coverages for our business, to which we've had a couple of claims on, and it's kind of a repository for funds. We own the captive company, so it all goes there. Are captive health insurance set up the same way, where you actually form a captive limited liability company and you deposit funds in it, and then after the claims are paid out, there's a pool? Does it work the same structure?
Yeah, there are a number of health insurance related captives in place today that are doing quite well, and they work very much the same way. So, a group of buyers get together, they form this entity called a captive. More likely, the entity already exists, the captive exists with reinsurers and other ways to layer the reg. And then you join the captive. They interview you to see if you're a good risk manager, and it would be therefore be a good risk to join their captive. So, it's a bit like joining a club.
Yeah.
But once you're let into the club, it's your capital that you're committing to it.
Yeah.
Uh, and if
And you're
you're
incented then to make sure everybody's healthy.
Precisely. And every participant in the captive has the same exact incentive. So the idea would be you make a contribution to the captive. If there are dividends or reserves left over, those are yours, right? So you typically leave some in reserve. You might pull some out in the form of a dividend, depending on how you think the historical performance of the captive has played out. And then you'll probably also suffer reduced administrative expenses because there's no carrier profit associated with that. So captives can be a very effective way to take a piece of the healthcare coverage and save some money. The thing that makes it a little more complicated with health insurance captives is you're really performing a captive for one element of health insurance, and that's the large claim stop loss.
Yep.
So that itself, if you assume that stop loss itself, the cost of that coverage is 25% of the premium, and then you have conventional markets who will also do stop loss. And if you assume the captive is 10% more effective than the conventional companies that do stop loss, it's just 10% on 25% or 2.5%. So it's a way to shave off some expense. Is it by itself a panacea to the healthcare dilemma in America? Probably not. But it's part of an effective arsenal of choices that you could make to bring down the overall expense.
When you think about company sizes, to basically join a captive group, what's the minimum number of employees that you really need to make it make sense?
The funny thing about that, John, is it differs by geography.
Oh, okay.
In the Midwest, they historically have self-funded down to 50 employees.
Okay.
On the left and the right coast, it's typically more like 150 to 200 employees. It's very odd, but you can find options for it literally down to 50 employees, particularly in the captives. They're interested in taking that risk these days, and there's a number of people who will look at it.
So, I don't think we're going to solve the country's medical inflation crisis on this call, but isn't it a shame that, Rich, how many times have we talked in 4 seasons of this podcast about treating your employees right and creating the right culture and the right environment and the right everything? But there is zero motivation. I hate to say that you need motivation for it, but there's zero financial motivation for entrepreneurs to do everything they possibly can to make sure their employees are always healthy. It strikes me as a huge opportunity for the medical inflation problem if employers of 2 people can be part of a captive group where by keeping their employees healthy and investing in their employees' health and caring about their employees' health because they're motivated to do it as well, it works for their business. And the better they do, the less they have to pay insurance for a company of 10 people or 12 people. I know it can't be done right now, but it just seems like that would be a huge opportunity for America.
And that's a good point, Jen, even setting insurance aside for just a second. So all of us are competing for talent, and the competition for talent is hot right now in most industries,
Yeah.
particularly key talent. I like to think about building a culture inside of an organization. If you can build a culture that people want to gravitate to, and then want to stay at, and then want to work hard at, that's recruitment, that's retention, and that's employee productivity. You can tackle those with an overall total reward strategy that has baked into it an emphasis on well-being. And I see an awful lot of employers thinking about that. And frankly, they're thinking about the savings and insurance as ancillary for the same purposes that you just mentioned. It's more around tackling recruitment, retention, and productivity. That's a big ticket item that employers can impact in a very real way.
Yep. Okay. So one thing you said, entrepreneurs, you should look at what the options are all the time. Don't stop looking and researching and learning. If people want to learn more, Mike, what should they do? They want to talk to you guys, learn more information, evaluate the opportunities.
Yeah, I think, first of all, there's a lot of good information outside of our organization. I'd love to give a pitch for us, but there's a lot of great information out on the internet these days around total rewards, recruitment, retention, activity, and things that you can do to mitigate insurance risk. Where you can find us is just worldinsurance.com. We've got a great website, and everything that I've talked about there today is on the website.
Awesome. Thanks for your time, Mike.
All right. Thanks, you fellas. I appreciate it.
Please stick around for a few more minutes while Rich and I break down this episode.
John, I was not aware that there are four vendors and four vendors only. Aetna, Insignia, United, and Blue Cross, although there are a couple conglomerates under Blue Cross, it sounds like. Did you already know there are four and only four, and those are the only options?
Yeah, no, I didn't know there was four, but it does seem like the same companies circle back around
Yeah.
a lot of times. The only method that I found as a small business to get better rates on our health insurance was to shop it around every year. So then one year you're with Aetna, next year with Blue Cross, next year with this group, to just try and save and as much as you possibly can. It does seem rich. As from in Canada, they have just health insurance. Your company doesn't have to provide you health insurance. There's everybody gets health insurance. It's not very good. That's a different problem. But companies aren't responsible for it. There's been a lot of conversation. We should have actually probed into this with Mike a little bit too. Like, where's it going? Like, where's the ball? Like, at some point, this isn't sustainable, right? The cost of pharmaceuticals and the cost of insurance. But the issue that I think exists in America, it exists in a lot of different areas, is the lobbyists. That's why the pharmaceutical companies are able to do what they're doing and put commercials on TV for their pharmaceuticals. In a lot of countries, you can't even put your commercials on TV for drugs. You should be pumping your drugs. You should be, the doctor prescribes it if you need it, not promoting it. Same thing with insurance companies. The reason why there's four and it's probably hard to get regulated is because there's some people making some pretty big bucks that take a lot of people out for dinner in Washington to make sure it stays at four. There's a lot of that stuff going on that I think is just not healthy for what he was talking about, free competition and lowering prices.
You had said in Canada, and I'm aware that it's paid for. You're born in Canada, you get health insurance. You said then, and it's not very good.
Yep.
What are the downsides that you see today? You live in the US, but you still have lots of family and friends who are in Canada. What are you hearing from them, or what have you or your family experienced as a downside to this? I don't know what you want to call it, universal health care
Yeah.
as a nation.
Yeah. First off, if something minor is to happen, need stitches or have a sore throat or whatever, would you go to the emergency room at the hospital today in Iowa?
I would go to a clinic that is a couple blocks away.
Yeah, urgent care clinic or
Yep.
convenient MD, which is a private practice business.
And they'd get us in within 20 minutes.
Yeah, there are billboards on the highway say 20 minutes or less. Come see
Yeah.
us, we'll take care of you. In a universal healthcare system, you're going to the, basically think about it as the hospital, and you're sitting in the waiting room for 3 hours to get your stitches done
Mm.
because that's the cost of it. And any doctor who's really good starts their own private practice in Canada because people are so fed up with just the wait time alone. And then the fact that all the good doctors who want to make money like the American doctors go start their private practices because people who have, enough money will actually pay for their own medical coverage because they want better coverage. So then the quality of doctors goes down. The experience is horrible. And so all the good doctors aren't even the ones providing the care because they want to make money like the Grey's Anatomy doctors or whatever they envision down here. So it's just not a great environment for the doctors or for the people, but it's free. Nothing is in life is good necessarily when it's free, as it's just not. It's great that it's free. It's not going to be the best experience. And I think here in the U.S. to take it a step further, we have a similar problem with the healthcare system. It's expensive. It increases every year at an inflation rate that's not sustainable. And it doesn't really provide any motivation for employers to make sure their people are healthy. I think that's another problem. So I don't have the solution for it, but I've done a lot of things to improve the culture of my businesses and do different things and have outings and do a bunch of, but none of it was really focused around health. And so I think we need to change the paradigm there a little bit with entrepreneurs or employers, but there's no motivation to do so. The government is the way the system currently works today. So I think that's a little bit of a problem.
Yeah, I've never been with any company who has said some of the things that Mike suggested. Hey, all of the men, go get your prostate exam. And the company markets that. Hey, all of the ladies, go get a mammogram. And the company markets that. That does seem pretty next level caring for your employees. And it also seems like it's gray area and almost crosses a line of what an employer's responsibility is to care for people. Is it do I really want to hear that from our HR person? Hey, Rich, have you gotten your prostate exam this year? It seems a little bit odd.
Yeah, I understand that it seems odd, Rich, but have you ever been with I've seen this before. Sometimes the health insurance companies actually do it where they'll pay for your health club membership, as an example. If you join a health club, right? There's ways that the companies don't just market it, they actually provide an incentive for it. Hey, this month is this month. If you go do this and prove that you did your checkup on this or that or the other thing, get an extra free day work from home as opposed to come to the office or whatever. I think there's ways to provide that incentive. Even think of yourself, like you're training right now for a triathlon, and that's going to help you become healthier, right? As your employer, that's really good for the company. You have more energy when you come to work, or you're training, or whatever those benefits are. But unfortunately, entrepreneurs, we think a little too financial sometimes. And if there's no benefit, you don't necessarily market. You should be marketing it anyway without a benefit to make sure your employees are healthy. But I think there needs to be a little bit of a switch if they really want the population to get healthier, motivate the employers to do it. I think that would really work.